Hey everyone, welcome back to Corporate Decoder. Today, QUCY just filed a Form 8 announcing the termination of a key sales agreement, and I am seeing signals of a potential shift in their strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is ending an agreement that allowed them to sell shares. And this could mean they are pivoting away from raising quick cash, but it also raises questions about their funding needs. Alright, let's dive into this filing from Cyber N.V, which trades under the ticker QUCY. The big news here is about something called an at-the-market issuance sales agreement. Basically, this agreement allowed Cyber to sell its shares directly to an investor, Maxim Group LLC, over time. Think of it like a flexible funding line where they could decide day by day how many shares to sell, and when, to raise cash. This is often used by companies, especially smaller ones or those in volatile industries, to get funding without needing a big, formal stock offering. Now, before they officially cut ties, Cyber used this agreement to sell over 3.2 million shares. This brought in about $4.3 million in cash. That is a pretty substantial amount, and it gives us a look at how they've been funding operations. The good news, or at least the non-punitive news, is that they are not facing any penalties for ending this agreement. This suggests the agreement was structured in a way that allowed for an exit without financial punishment. So, what does this termination really mean? Companies typically use these at the market agreements when they need ongoing access to capital. Ending it can signal a few things. It might mean they feel they have enough cash on hand for now, or perhaps they are looking for a different, more substantial financing route. It could also mean they have a new strategy in mind that doesn't involve diluting their existing shareholders by issuing more stock through this method. Let's consider the context of Cyber as a company. They are in the healthcare diagnostics and research sector and have a relatively small market cap of around $41 million. Their stock price has seen some volatility, trading between 30 cents and almost $5 over the past year. Recent news headlines mention them venturing into defense with autonomous drones, which is quite a pivot from healthcare. This also raises questions about their core business focus and how they plan to fund these new initiatives. The company shares are registered on the Nasdaq Capital Market, which is a decent exchange for smaller companies. They have ordinary shares with a nominal value of 1 euro cent each. Cyber has identified itself as an emerging growth company. This status allows them more flexibility in financial reporting and compliance, which is common for companies of their size and stage. Ending this sales agreement, especially with the company exploring new avenues like defense technology, is a key event. It suggests a potential turning point. Are they securing a larger, more strategic funding deal? Are they confident enough in their new ventures to not need this flexible cash source? Or are they facing challenges that make selling shares less attractive right now? It's definitely worth watching. The most critical takeaway here is the shift away from this method of raising funds. Historically, companies that rely heavily on at-the-market offerings without clear revenue growth can signal underlying financial weakness or an inability to secure traditional financing. For example, companies that frequently tap these agreements often find themselves in a cycle of dilution that can depress stock prices. While Cyber is not facing penalties, the move away from this capital raising tool is a significant event that warrants attention. We'll be watching to see what their next financing step is and how it impacts shareholder value. That is my take. Stay decoded if you want the broker and charting tools I use. They are in the description, affiliate links that support the channel. Like and subscribe if you found this helpful.